Good morning. Thank you for the introduction. So welcome everyone to this online information session. So this is a finance specific session that follows up from the general introduction that was made some 2 weeks ago about the financial closure report, what are the expectations there, and also the launch of the progress update report that is coming with this 30th of June period end. So what we will look at specifically is what are some key insights, what are the things to look out for during this financial closure reporting session and the PU session. We will also deep dive into the different sections of the report and provide you with tips, provide you with guidance, and provide you with what are the expectations from the Global Fund on what should be reported in the different sections. And more importantly, we want this session to be engaging. So we have changed the Q&A format. So we will stop at 3 different points throughout these 2 hours that we're spending together. And we will take your questions on some specific sections. So we encourage your active participation, and as we mentioned in the introduction, feel free to post your questions as we go along, and we will stop from time to time to answer these different questions. So thank you again for joining us. We look forward to an informative and productive session, and we hope that by the end of this session, you will be better equipped to go through this reporting season for the FCR, but also for the PU that is coming. So this is the agenda which outlines the structure of what we are going through. As already mentioned, so we will just give you a brief overview of what is expected in terms of the implementation oversight throughout 2024 and beyond. So focusing not only on the GC6, C19RM reporting, but also on GC7 and what lies ahead. We will dive into key areas during the preparation of the FCR, and then we will go detail into the content of the FCR and the PU as well. Why we have structured it as FCR and PU is that whatever you will see in the PU is already to a large extent covered in the FCR. So in order to avoid duplication, we will just browse through what are the incremental additions on the PU. We will also provide you, together with after this session, the slides, the guidance notes, the recording of the session, and any other resources that you may need in order to check quickly, in order for you to make as reference point, and for you to have an overview of all the different requirements of the Global Fund. And of course, we will end up with any residual questions and questions that you may have, and we'll try to provide answers as concisely as possible. So moving on to the next slide, it's just to give you an overview of what lies ahead in 2024 and beyond. Next slide, you will see that we've already mentioned that in a couple of sessions we have had together, is that the reporting rhythm is now changed, at least for what is the outlook in 2024. So you will remember that in GC6, we used to have 6 reportings for finance throughout the year, with 4 pulse check, 1 progress update report, and 1 PUDR. So this reporting rhythm has now been reduced to only 4 reports per year, with a Q1 pulse check, a Q2 PU, another Q3 pulse check, and the Q4, which is the yearly report, which is either a PUDR, a final PU. And then, of course, at the end of the cycle, 6 months, up to 6 months after, we will have the financial closure report. Now, on to the next slide, where you will see, for instance, what are the different reports and when are these due. But what is more important for you to understand is the accumulation principle in terms of the financial information that is required in those different reports. So if we take the example of a grant that started on 1st of January 2024, so the pulse check for the Q1, which is as of 31st of March 2024, is due within 35 days. And accumulation is whatever happened from 1st of January to 31st of March. Now, if we move on to the Q2 PU, so both the cash information that is provided and the expenditure information that is provided is cumulative from the 1st of January 2024 to 30th of June 2024. So whatever has happened within these 6 months, and this is due within 45 days from the end of the reporting period. So when we will come later during the year as of 30th of September to the Q3 pulse check, so that again will accumulate everything from 1st of January to 30th of September. And then when we will have the PUDR at the end of the year, so it will be one full year PUDR, taking expenditures from the 1st of January to 30th of June, 31st of December 2024. Now, the question that you may ask is what happens in year two? So in year two, what will happen is that the Q1 will again start covering only the 3 months from 1st of January 2025 to 31st of March 2025, and so on. And as always, the closure period is due within 45 days of the closure end date. So if you have a grant, for example, that ended on 31st of December 2023, so the closure period end date is 30th of June 2024, and the FCR would have been due as of 15th of August 2024. Now, moving on to the next slide, where you will see that one enhancement that has been made is that the PRs can now submit pulse check and PUDRs section by section to allow for timely insight. And as you know, for the different sections, if we move on to the next slide, so you will see that there are 3 distinct sections, so which is the programmatic section, the financial section, and the PSCM and growth management section. So what it means is that each section can be submitted separately. So if, for example, you are able to finish the financial reporting on one end, so you can actually submit this financial reporting section back to the Global Fund to allow the Global Fund to start its review process. But remember that a report is considered fully submitted only when all the different sections are submitted together. So I will pass on to my colleague Tanaka Ndowa from Secretariat Financial Process and Optimization Department. So he will take you through to what is required in terms of the systems and processes. Over to you, Tanaka.
Yeah. Thank you. Hi, hello, everyone. So if we can go to the next slide, please. So as you may recall from the previous session, one of the changes that we've also made with this round of reporting is that we're introducing reporting via online forms. And next slide, please. With this, we have introduced 3 ways to enter results and report results to the Global Fund. So the first modality, first way to enter results is direct data entry into the online form, which is the method that as the Global Fund, we strongly recommend to use. And we have also with this, the third mode of entry, made available a copy paste functionality, also called the data import wizard. Some of you may recall this from the pulse check starting from June of mid last year. So it'll allow you to update data into the system tab by tab. Directly from your sort of Excel working files, you'll be able to copy the data that you need and paste it into the portal. And on the portal, there are instructions and guidance about how to do this for yourselves. We have made this available for 4 tabs. So you'll see those at the bottom with the asterisk. That's for the expenditure report, the cash reconciliation, the commitments and obligations, and the SR cash reconciliation. So these are mostly the tabs that have a lot of heavy data entry. And so the copy paste can support the direct data entry method that you can use for the portal. We are still also providing the supporting Excel, which you can download from the portal, complete, and attach back to the portal, where you'll be prompted to import the different sections of import data from the different sections of the Excel. Those sections will be programmatic, financial, and PSCM. For FCR, obviously, only the financial part is relevant here, so you'll only be able to import the financial part. Just to note that whichever data entry method you use, the final review and submission is only based on the online portal. So as the Global Fund, we will not be reviewing the Excel. We only review whatever is on the portal screens. And even to process a submission, if you use the Excel, you still have to go through the data quality checks in the portal. And with that, we can go to the next slide for the data quality checks. So the data quality checks, and this is something many of you have seen as part of the pulse checks that we rolled out for Q1 this year. So we have expanded those data quality checks to all the tabs of the FCR, with the idea of improving the data quality by flagging potentially incorrect or misaligned data in the submission, preventing data entry errors, so text in cells that should have numbers, etc., and ensuring sort of a full, consistent submission. All number cells have to have a value entry. We have, for example, errors in the expenditure report, so that the expenditure by cost input, module intervention, and implementer have to be aligned before they're able to be submitted to the Global Fund. And we have two types of data quality checks. So we have one which are errors. So these are cases where it's not possible to proceed with the submission because the data that is being entered is incorrect and needs to be corrected. So you'll be guided by the data quality section as to where the error is and what needs to be addressed in order to move forward. The second data quality check we have is a warning message. So these are flagged to the system, which will will provide information saying there's potentially an issue with part of your submission. However, it could also be correct, and it just requires a justification in order for you to proceed with the submission. So an example of the error is, as I mentioned, the misalignment of expenditures between cost input, intervention, and implementer. An example of a warning we have in the PR cash reconciliation tab is if you have a negative cash balance, and in 5.1 as the Global Fund, we just require an explanation as to why it's negative. Maybe it was an issue in the data entry, but maybe it's a correct scenario. Thank you. With this, I'll pass on to Bogi.
Thank you, Tanaka. Good morning, good afternoon, everyone. My name is Boglar Kalaza, and I'm the Senior Finance Specialist for the Grant Financial Management team. So we're gonna look into some key areas, key focus areas for the FCR, what you need to look out for during the preparation. And also for those of you who are still coming to the last PU, these are some of the tips that will be very helpful for you in preparation of the final PU. Next slide, please. So our first topic is expenditures and how we need to make sure that those expenditures are complete and accurate. Our first point is expenditure categorization. So you need to ensure that those are categorized correctly by funding sources or by the modules and interventions or cost inputs as well. Then we have the accumulation of expenditure, where the cumulative expenditure of the FCR should be reconciled with all the periodic expenditures when they are summed up together. Regarding to financial commitments and obligations, as you know, that expenditure are inclusive of financial commitments, but exclusive of obligations and advances. For WAMBO and direct sourcing, you need to make sure that you reconcile the goods and services delivered that were procured from WAMBO or directly sourced and in the expenditure sheet with those WAMBO and PSA reports. Next slide, please. Non-compliant expenditures are also an important part when you're looking at the accuracy of the expenditures. As you know, non-compliant expenditures should not be included in the expenditure sheet. And taxes, unrecovered taxes are also considered non-compliant, so those are also excluded from the expenditures. We also recommend that you reconcile all your non-compliant expenditures throughout the IP, even the long outstanding ones that are due for recoveries and which were already communicated previously by the Global Fund in the performance letters. For C19RM 2020 specifically, as you may recall, those were the expenditures that could have been incurred until June 2021 with those two specific interventions under risk mitigations and the COVID control and containment. So once those were reported back 2-3 years ago now, those expenditures shouldn't change, because when those expenditures change, it changes the rollover figures for the C19LM 2021. So we see that we have seen in a couple of reports subsequent to the PU of June 21 that those expenditures kept varying without any justifiable comments, basically. Next slide, please. And then I'm handing it back to Fadil. Thank you.
Yeah, thank you very much, Bogi. So just a pause here to recap on what are financial commitments and obligations, because this become very important at the end of a cycle. So remember that when you as a PRs, you submitted the final PU, so there were commitments which were provided. So commitments are part of expenditure, as Bogi mentioned, and commitments relate to goods and services that were delivered before the end of the reporting period, but not yet paid for. And why do we require a listing of financial commitments and obligations to be provided? Is that in the closure period is actually the period at which we determine how those commitments have been liquidated. And when these commitments are liquidated, it is important to note that if, for example, there are commitments which were denoted in currencies other than the IP currency, like, for example, if you have a grant in euro and you have an expenditure which is done in CFA franc, for example, so then there would be no exchange rate issues because of the parity. But if you have other reporting currencies that have a fluctuation in the exchange rate, so it is important that the exchange rate that is used to liquidate the commitment is the spot rate at the date of payment. And there could be differences between the commitment that was recorded at the time of the final PU submission and the actual value for which the commitment was liquidated. So if we take a concrete example, let's say you had 10,000 euros worth of commitments that were recorded as of the PU of 31st December 2023. But then with the exchange rate differences that happened, so these were finally settled for 11,000. So what it actually means is that the total amount of the commitment has been liquidated. But then in terms of expenditure, there is an additional 1,000 euros worth of expenditure that needs to be recorded in the financial closure report as additional expenditure that happened. Now, financial obligations, on the other hand, there were no goods or services delivered, nor were there payments which have been made, but there was a contract at the final PU reporting date for these activities to happen. Now, what we are looking at in the closure period is how these obligations have materialized or not. So if you have an obligation that has materialized, that meaning that the goods or service has been delivered and payment has been made, so then this obligation is extinguished. However, if at the end of the financial closure period, this obligation is still there, it has not yet been paid, the goods have not yet been delivered, or they may have been delivered as well. So then the proper treatment is to move these obligations to the next implementation period. So if you are PR continuing into GC7, so then any surviving obligation at the end of the reporting period, at the end of the financial closure period, will move to GC7. Now, you remember that we said that we require the detailed listing of commitments and obligations to be provided. And the reason why we require this to be provided in the prescribed format, meaning that it needs to include the activity description, the relevant module intervention, the cost input or cost grouping, and the implementer associated with the activity, is that when these are liquidated, if there are any adjustments, so it is easy for you as PRs to make the adjustment into the expenditure section. And if it is an obligation, for example, that needs to be transferred to the GC7, so you already know which are, in terms of the summary budget, so where this adjustment needs to be provided, so then you can identify and make the adjustments accordingly. Now, moving on to the next slide, you will see also that the uses of fund is according to what is prescribed in the allocation utilization period. And what is the AUP actually? It is the period of usually 3 years over which the country allocation per disease component can be used to implement a grant. Now, there are instances, for example, where certain payments relating to goods or services that are delivered after the AUP end date. So meaning that if you have a grant that started on 1st of January 2021 and ended on 31st December 2023, so there are special circumstances under which these goods or services delivered after the AUP may be considered as expenditure. But it is very important to note that this applies for HTM only, meaning the regular funds for HIV, TB, and malaria, because for C19RM that continue after 31st of December 2023, there is no financial obligation or slippages, or even if your C19RM use by date was 31st December 2023, there is no obligation or slippages that are allowed for C19RM. Now, let's move to the next slide where we will see in more detail what are these AUP slippages. So basically, your country team will have communicated to you that there are 3 criteria under which allocation utilization period slippages can be approved. So first is that the order for the goods and services were placed with adequate consideration for the lead times, so that the goods and services could have been delivered before the end of the AUP. Now, this is the first condition that will then trigger the next 2 conditions. Now, it can happen, as we have seen in the worldwide disruption in terms of freight services, that the goods or services are delivered beyond the AUP. And the reason why this delay happened was beyond the implementer's control, meaning that you could not at your level influence the outcome of this delivery. And then the third condition is that these goods and services need to have been delivered within a maximum of 180 days from the end of the allocation utilization period. So meaning that if you had a grant that ended on 31st December 2023, and the goods were, let's say, the transaction respected the first 2 conditions that are outlined there, and the goods was, let's say, delivered on 20th of May 2024. So then this the third condition would have been fulfilled. But then for all these conditions, it is necessary for you to obtain Global Fund approval. So if we take a simple example, let's say that you are a PR and on 1st of December 2023, you ordered via PPM Wambo for goods to be delivered. And when you place that order, clearly the date of delivery was, let's say, 15th of February 2024. So we see there in that example that the first condition is not met. That is, the goods should have a lead time for delivery before the end of the AUP. So then in that case, the first condition is not met, and then the AUP slippage is not applied. Now, if, for example, the order was made on 1st of June, the delivery was scheduled for 30th of October 2023, but then the shipping routes were so complicated that now the goods are planned to be delivered on 30th of March 2024. And this delay is beyond the implementer's control. So then all 3 conditions are met. And these goods and services can actually be considered as slippages. And when they are considered as approved slippages by the Global Fund, what it means for you as PRs is that these can be included as expenditure against the GC6 grant utilization period. Thank you, and I'll pass it back over to Bogi for the remaining part of this section. Thanks.
Thank you, Fadia. So we're going to talk about the closing balance for the FCR. First, we're going to dive into the opening balance. So what you will see in the opening balance, that is 1.1 in the section of the cash reconciliation, is that field is pre-populated, and it's pre-populated based on various rules depending on what type of grant you have. So if your grant has no C19NM funds, then that figure is pre-populated from the last, or from the final PU in this case. If the grant has C19NM funds, then it is pre-populated from the pulse check from the end of the previous financial period. But if your grant is a focused portfolio and there was no pulse check, then it is pre-populated from the latest PUDR or the final PU. And then if still any correction need to be made, you can do that in section 4 in reconciling adjustments. For the closing cash balance, so you will see that you have seen already in the pulse check how the cash reconciliation looks like from section 1 to section 5. And that is only the PR cash reconciliation, right? So at 5.1, you will arrive to the final balance of the PR. Now in FCR, we need to complement that with the advances. So we are bringing all the advances back to that cash reconciliation tab. And in section 5.2, we are bringing that back, which will calculate in 5.3 the complete final balance of the entire IP. And we'll have to introduce later, we'll go into details of the split of the closing balance by the funding sources. Because as you know, the previous PUDR form was not fully splitting the cash reconciliation by funding sources in the same way as the new PUDR is doing it. So you will see how we're going to calculate that backwards. And then we're going to talk about now the non-compliant expenditures. So we mentioned it in the expenditures section that non-compliant expenditures are not reported as expenditures, but they are cash outflow. So you should not be adjusting for the non-compliant expenditures until they are recovered on the PR's bank account, because otherwise you will artificially inflate the cash balance. That is not true. And just to mention again, unrecovered taxes are also non-compliant, so the same goes for those items as well. Next slide, please. Specific attention should be made for section 4, which is all the other reconciling adjustments. So for 4.1, we would only accept valid and well-supported adjustments here. This is only a one-cell entry, and with only a comment box, so it's not very detailed in the cash reconciliation section. We highly recommend that detailed spreadsheet. If there is many reconciling adjustments, then a detailed spreadsheet is attached with the submission, so we can see what those items are one by one. And also 4.1 for the FX gains and losses. As you will see that there is a cover sheet where you can enter the FX rates, closing, opening, and for the expenditures as well. So those calculations should be made correctly. With regards to section 9, where we see the bank reconciliation and the variances against the PR's cash balance, we've seen based on the post-check reports that there was some confusion in this section. So basically 9.1 is where the PR should provide the bank statements. You need to attach the bank statement. And in case of multiple bank accounts, you attach all the bank statements, and the totality of that in the IP currency should be entered as the amount for the form itself. Section 9.2 is the bank reconciliation. So here we're talking about an attachment of bank reconciliation for items that were not yet booked in the PR's accounting, or for commingled accounts. This is where you could also explain the reconciliation of the different grants under the same account. And then automatically calculated from this information 9.3, which is the variance of 9.1, the bank statement, and the PR cash balance in 5.1. And 9.4, that is the variance of the bank reconciliation and the PR's cash balance. If there is any variance in these cells, those will require a mandatory justification in the comment box. Next slide, please. And I think I'm handing it back to, no, this is still with me, sorry. So the triangulation is like the heart of the FCR, as you know. And the objective of the triangulation is to ensure completeness and accuracy of financial information, which involves the reconciliation of the cash and the expenditure together with the commitments and the open advances. So You know the FCR now, you will see that we have updated it with the cumulative triangulation for the whole IP, which is a fully automated tab in the form itself, which is linked from previous PUDR information and also from the current FCR, different elements of part of the FCR. So you will see that the structure remained the same as in the PUDR previously. So you will arrive to a variance between the calculated cash balance and the cash balance that was presented in 5.1. And then there will be this variance from which you could further break it down into those justified triangulation variances, which could be either an SR income or an SR exchange, ineligible tax refunds, or any other justified variances that may arise. And then after that section, you will have the final variance, which will be considered an unjustified triangulation variance. Ideally, there is none. So that's our aim, to have no unjustified triangulation variances. And then this triangulation tab is also enhanced with the expenditure accumulation check, which I explained before during the expenditure discussion. So there will be section 13.2, which automatically will calculate the expenditure accumulation, taking it from each periodic expenditure from each PUDR and accumulate it mathematically, and then we'll compare it against what was reported then eventually in the FCR. In this section, there shouldn't be any variances. If there is any variance, that adjustment needs to be made in the expenditure for the FCR. So here we are really aiming for 0. It cannot be anything else there. And I think now I'm handing it back to Fadil. Or we are opening it for Q&A, indeed.
Thank you very much. So I think there are some questions which have already been put into the chat, and thank you very much for that. Keep the questions going as we go along. So I'll invite Tanaka to help us answering questions 1 to 4, please. Thanks.
Yes, thank you. So for question 1, so we will be providing the supporting Excel. So every online form that is sent out, you will have there a possibility to download the supporting Excel to accompany the online form. And the second part of this question and question 2, I can answer together. So the forms are shared when the FCR PU is sent to the PR. Those dates are to be confirmed and will be shared with you centrally. I think, as mentioned, it's going to be looking, as mentioned in the previous session, it's going to be somewhere around end of July. For question 3, so for those countries that are not able to access online, they only have the Excel form. So the Excel doesn't have all the data quality checks and controls as the system does. So we encourage PRs to review the handbook and the list of data quality checks, warnings, and errors that is in the handbook to ensure that their submission is compliant before sending it to the Global Fund. Question 4, if I upload the Excel sheet with the information on the portal, can it populate automatically through optical character recognition, or am I required to populate manually? So if I understand, so we have 2 ways of uploading data from an Excel to the system. We have one, which is the data input wizard, the copy paste. If you copy and then paste, copy from Excel and then paste the information into the portal, whatever you've pasted will be read by the system and loaded for the applicable reporting forms in the portal. If it is about the supporting Excel, when you come and attach it, it will process an import of the information that's in the supporting Excel and should also reflect that on the portal. However, we do strongly recommend that PRs review the Excel form, the online form after the import to make sure it's populated correctly. Thank you. Over to you, Fadil.
Yeah, thank you very much, Tanaka. So on to question 5. I think this one is anticipating already on the next part of the session, but just to keep a concise answer to that. So we know that, for instance, when the PU is reported, it is reported against a budget which is a full year budget, but then there's only 6 months worth of expenditure that is provided. So we also provided that the variance analysis is to be provided in relation to where the variance amount is plus or minus 15%. But for the PU, it is different. For the PU, and you will see that when it comes to the guidance that will be published. So you're only required to provide information as to how the outlook for that activity is throughout the year, whether the PR is still on track to making it, whether there are contextual information that could explain why some things are delayed, or to the contrary, why some things have been accelerated, and if also the PR foresees that there will be savings that will come out of these lines, or to the contrary, whether these lines need to be further buffed up, maybe from budgets from subsequent periods. So at the level of the PU, it will be very much contextually explaining the direction of travel to reach that year-end objective that is provided there. Moving on to the next question. So the PUDR reporting deadline is 60 days. Yes, after the end of the IP, that is correct. And the FCR is 45 days. So the final PU, so the one that you did at the end of December 2023 for a grant that ended as of that date, was due 60 days after, and that is correct. And the FCR is 45 days, and that is confirmed as well. So the FCR, again, is 45 days after the end of the reporting period. So you will also have noticed that there might be some delays in terms of the rollout of the FCR. So we will communicate to you in terms of when this will be available. But the 45 days that is provided there is correct. Question 7, could commitments be included into the FCR? So commitments, again, are expenditures, or rather goods and services that have been delivered by the IP end date. So when it comes to the FCR, the balance of commitments that need to be provided at the end of the period is 0, because commitments would either have been liquidated, or if they have not been liquidated, then they would have to be transferred to the next reporting cycle. So meaning that if you had goods and services that were delivered before 31st of December 2023, you have a 6-month period from 1st of January 2024 to 30th of June 2024 to liquidate these commitments. Now, in normal business terms, it would be very much of a stretch of imagination to think that goods and services have been delivered, but then it takes more than 6 months to liquidate those commitments, which is not appropriate in terms of what we recommend in the treatment of commitments. Which also links to question 8, so 6 months liquidation period. So basically, the 6 months liquidation period at the end of the grant. So remember that the grant ended on 31st of December 2023. So the 6 months of liquidation period that is mentioned here is the 6 months closure period. So closure period is the 6 months that is provided for which the liquidation needs to happen. Now, the 45 days that is provided is for the PR to now report back to the Global Fund what has been the result of all this liquidation. So what it means is that you have 45 days from the end of the 6 months to submit the FCR, knowing that the IP already ended on 31st of December 2023. Now, question 9, when you transfer obligations for GC6 to GC7, does that mean that we're mixing two grants? No. When you're transferring obligations from GC6 to GC7, you are only transferring the obligation, not the budget that is associated with that. So that what it means is that you will actually need to find savings within the GC7 grant in order to accommodate those obligations that were not paid for under the GC6 grant. So again, it respects what we mentioned as the allocation utilization period, which means the 3 years within which you had the opportunity to spend the GC6 budget. And if this was not done within the GC6, so this is when it moves on to the GC7, but without the additional budget to GC7 coming from the GC6. I think question 10 also speaks to it. So moving non-paid to GC7, will it not change the GC7 allocation? So as mentioned, no, you will have to find savings within the GC7 to accommodate whatever has not been paid under the GC6. Question 11, will the January to June 24 PU be reviewed by the LFA? So we have already communicated on that, and you will have seen the PU that was done last year for June 2023. So all PUs do not have mandatory LFA review, at least for the finance section. So we are not here talking about programmatic results that could still be subject to some verification, but at least for the finance section, there's no review by the LFA of the June of the half-yearly PUs. So I think question 10 and question 12 have been answered, as it relates to the same. Question 13, financial obligations that were moved, should they be listed in the FCR for GC6? Yes, they should be listed, and this is why you will see that in the prescribed form, so there are details as to what are these financial obligations that still remain at the end of the GC6 period, so that we have a basis on which to identify what are those obligations that are approved for transfer onto GC7. So in your prescribed form, so you will find elements like the module, the intervention, the cost input or cost grouping related to it, the activity description, and the implementer, so that when you move these to the GC7, so you know where in the summary budget to make the required adjustment. Question 14, is it possible to make payments after the closure period of June until the submission of the FCR? You will have to consult your country team with respect to that, but technically this is possible, subject to there being no additional delays to the submission of the FCR, meaning that you cannot come and tell the Global Fund you are going to delay the submission of the FCR because you have payments that are outstanding. So this is not allowed, but so long as, for example, there are some payments which happen, let's say 15th of July, but you're still within your timelines to submit the FCR. So this can be done, but again, subject to you informing your country team and them telling you that it is okay to do so. Question 15, so our IP end date is 30th of June 2024. Our PR is June 30th of August. And when is our FCR due? So if your IP end date is 30th of June, it means that this is the date for the final PU preparation. Now you have 6 months after that to prepare to do the closure period and to prepare the FCR. So meaning that your closure end date will be 31st of December 2024, and your FCR is due on 15th of February 2025. So question 16, if the C19 RM was extended till September 2024, how will Q3 2024 be reported? So I think this question also entails understanding when was the regular grant utilization period ended. So if, for example, this grant had, let's say, a PUDR or a final PU that was due as of 30th of December 2023, but then the FCR use by date is extended till September 2024. So the Q3 will be reported as a pulse check, and there will be an additional 6 months to liquidate all that. But maybe I'll ask for support from maybe Bogi, or can you help me on question 16, please?
Sure. So I think if in your example, this December IP end date, that means there was a 9 months extension for the C19 RM. So then taking December IP end date, there is a 6 months closure period for the HTM grant. So in that case, at June, they will submit a combined FCR for both. And then in September, they will be submitting a last PU for the C19RM only, which will be followed by another 6 months of closure period until March, where they will submit the final FCR, if that's the case. If the IP ended in June, for example, and the C19RM is only a 3 month extension, then we will allow the PR to have a combined closure at after, so the closure period will be extended by 9 months. So it will be the 3 months overlapping with the continuation of the C19RM between June and September, plus from September another 3 months of closure. So those are very specific cases. I think we only have 2 grants in the whole cohort where we have this 3 months extension for C19RM. Moving on to the next question then. Question 17, but we don't have a section to first of all get the total triangulation variance before deciding what is causing it. Yes, of course. So the triangulation will see the screenshots from the system, from the forms. So the triangulation remains the same as in the current PUDR. So we'll start from the opening balance, taking out the, adding the income, taking out the expenditures, the net of commitments and the advances to arrive to the calculated closing balance, which will be then compared with the reporting closing balance. And that's your first triangulation variance check. And then after that, there will be a section for the justified variances to input those, which will then result in another second line triangulation variances, which will be determined then the unjustified variances. Question 18, for grants ending June 24, is the PU due after 45 days, or is just the PUDR after 60 days? We got the 2 deadlines in one of the communication from Global Fund. Is for the last PU, right? That's the question. I'm just trying to.
Yeah. So
you get.
If you have, so if it is a grant that ended on June 24, so then a final PU is due. And if a final PU is due, so the deadline is 60 days. Now, after this final PU, so the PR will have a 6 months closure period. So then the FCR will be due 45 days after 31st of December 2024, so which is then 15th of February 2025. Yep. The next slide. Okay, so when I look at the questions that are there, many of these questions will be answered in the next part of the presentation, so which is about the deep dive into the different sections of the FCR. So what I suggest we do is that we keep questions 19 and beyond, and then we'll answer them in the second part of the question and answer time when we have gone through these different sections of the FCR. So maybe if we can move on to the FCR and the content. So basically, moving on to the next slide, this is something that you have seen in our different presentations. So when you think about the cash reconciliation section, so whether you're doing a post-check, a PU or a PUDR, so it is the same structure that is harmonized across all the different quarters. Now, Bogi, when she will speak about the cash reconciliation section for the FCR, she will explain to you what are the 4 additional lines that we have provided in the FCR. And then what you will also see in terms of the section is that there is provision which has been made for multiple source of funding. So meaning that previously they used to be within the same report both HTM, so meaning the regular funds, and also C19RM, but now this is being separated to provide additional overview on the different funding sources. And of course, what we have introduced, you will have seen that when we did the pulse check rollout, is a new section on refunds. So that is incorporated to address triangulation variance, but also for the PRs to keep track of what are the different sections that are available. So moving on to the next slide. So in terms of the FCR, and why is it important, this slide? Because you will see that when it comes to the PU will be a subsection of, or a subset of all the different tabs that we are going to cover here. So of course, we will have the cover sheet, and you will recognize many of these different sections as being the same that was available in your PUDR in terms of the different sections. So you will have a cash reconciliation section. So you remember there was an open advance that was there, SR cash reconciliation, commitments and obligations, the detailed listing. There are some adjustments or some enhancement to expenditure report, triangulation controls which have been enhanced, and maybe the new addition or the new element here is tax reporting, which was not something that was previously included in the FCR, and we'll explain why we have introduced it here. And of course, some simplification into the non-compliant expenditure section. But without further ado, let me pass on to Bogi, who will walk you through the PR cash reconciliation section. Thanks.
Thank you. So many of you have seen this already when you submitted the pulse check, those of you who had to submit the pulse check. So you'll see that the cash reconciliation remained more or less the same for the FCR. The first thing I want to talk about is the cover sheet, which is the same as before in the Excel template. You'll have the opening and the closing rate, as well as the rate for the cash outflows. Next slide, please. So this cash reconciliation, as Fadil already introduced it, we had a vertical distribution based on funding sources. So if you have a grant with both funding sources, you will see, as it's presented here, a regular column, a C19 column, and a total. If you don't have C19 funds, then that will not appear in the system. So the opening balance, as we explained, it's pre-populated, and it will be dependent on what type of grant do you have. Next slide, please. Section 2 remained the same, so you will see the disbursements pre-populated here, as well as I need to highlight that for the FCR itself, for every reporting period, the disbursements are populated until the end of the reporting period. So if you have an FCR until June, you will see all the disbursements appearing up to June. This is not a live form, so this will not be updated, obviously, throughout the reporting preparation itself. So if there was any disbursement after the reporting period ended or any refund, those will have to be manually added in section 4.1, other reconciling adjustments. Then, as always, you have the interest and the income generating revenue from income generating activities in as an input cell for you to enter. Next slide, please. So section 2.7, from 2.71 and 2.74, these are new sections. These are refunds that were separated here as part of the income to make it more visible and easier to track. So this was previously explained as the reduction from disbursements or other way of calculating it, but now we separated them so they are easier for tracking. Next slide, please. The outflows remain the same, so you will see it exactly as before. You'll see the payment there and the disbursement to SRs and the bank charges. There was a question. It's simply.
Okay, you froze for a second, I think.
Did I? Oops. Now? No?
All
Yeah,
good
now we can hear you.
Where
Yes.
did you lose me? Sorry. I actually got a flash that internet was not okay.
Yeah, we lost you at
Maybe-
2.3.
3.3. Okay, so then I was just saying that there was a question on bank charges. I saw it flashing up, so let me just quickly answer that. So the C19 cell is grayed out because many PRs have one bank account for both funding sources, so it's just easier to track it as to be borne by the HTM grant. It's not that easy to split it up by the funding sources. It's not, and normally these bank charges are not that significant to to make a big difference in the cash reconciliation. So it's just to simplify the PR's life when splitting up the funds. Next slide, please. So section 4, I briefly talked about it before. Here you will see 4.1, that is an important cell with other reconciling adjustment, which is where we would want the PRs to input anything that would be reconciling, that would be necessary to reconcile the final cash balance. As I said, it's a one input cell, I mean, two for the different funding sources. But it's better if there is a lot of adjustments made, it's better to have an Excel spreadsheet attached to the submission so we could see what those items are that are modifying the final cash balance. And as always, there is the FX gain and losses on translation. Next slide, please. And this is where we have the additional 4 lines. So your post check ended at 5.1 at the PR's cash balance. Now what we are bringing in for the FCR is the open advances and 5.2, which would then conclude the closing balance for the whole IP in 5.3. And then we introduced section 5.1 as the closing cash balance to be refunded to the global fund. So for example, if your C19 fund is ending, there is a closing cash balance that must be refunded to the global fund because those funds are not getting reconciled with the new IP. And in some cases, PR decides to refund part of the balances. We have seen those cases before. So it is really for the PR to determine how much money is that they're refunding and how much is that they will be reconciled.
You are freezing again, it seems.
Yeah, maybe I'll take over. All right, Bogi, we lost you at 5.4.
Really?
And maybe if you would turn off your camera, sometimes it can.
Okay, let me see. Do you hear me now?
Yeah,
Yes.
we can hear you.
Okay. So what I was saying, 5.4 is the refund, basically. I don't know how much you heard of that, but basically it is for the PR to decide what they plan to refund, which would then calculate the 5.5, which is the cash balances to be reconciled and transferred to the next IP. And then I think that's it for this one. Next slide, please. Okay, so this is the bank reconciliation section, which I've already talked about before. So here you will see 9.1, where the PR needs to input the total of the bank statements, if there are multiple bank statements, or the one bank statement that they have in the IP currency. So that's important that the amount is translated to the currency of the grant. 9.2 is the bank reconciliation. So this is used for to represent those amounts that were not that are not in the bank, that were not yet booked in PR's account, so those unpresented checks or any bank charges that were not included in the final balance. So, and also this is used for commingled accounts when the PR has only one account for multiple grants. And then 9.3 and 9.4 are calculated automatically. And if there's any variance for those, they need to enter a comment in the comment box. Next slide, please. So you will see that after every section, we'll have these common mistakes part where we'll talk about our experience from previous IPs. So the first common mistake is whether the opening cash balance itself is correct. So this is where we explain that those opening cash balances are coming from different reports depending on what sort of grant you have. So if there is still a need for adjustment, that you can do in section 4. And then, as I already highlighted, non-compliant expenditures were adjusted in the cash flow. That is a big mistake, and this still happens. So it's important that open non-compliant expenditures are not artificially inflating the cash balance. Those will be adjusted for once they are refunded. Those are adjusted for in 2.7.4. That is a refund of ineligibles. Section on the reconciling adjustments where they are not explained or justified. As I said, 4.1, it's better if you attach a spreadsheet that is detailing all the adjustments that were there, so we can understand them item by item. On the FX, just make sure that those are calculated correctly, the translation of balances. And important note that in section 4.2, it's only the PR's cash. It should be only calculated on the PR's cash. For the SRs, there is a section for the FX gains and losses in the SR reconciliations. And the cash balance split by funding source, it could be incorrect. So we will discuss this later on in the triangulation controls, how we are determining the funding source split. And as I just said before, the misunderstanding of the bank statement and bank reconciliation. So please ensure that 9.1 is the bank statement figure and 9.2 is bank reconciliation figure. And those are filled in correctly in the IP currency. Next slide, please. And I think I'm handing it back to you, Fadil.
Yeah, thank you very much. So in terms of the open advances, so basically going back to the definition of open advances, so these are cash payments which have been made, but for which no corresponding goods and services have been received. So you will see here that this table is broken down by regular funds and C19RM. So what is important for you as PRs to understand is that when you fill in the open advances, the opening balance, so that 6.1, when you did the final PU as of 31st of December 2023, there was not the split by funding source. So which means that one of the first items that you will need to be wary of is to make sure that when you split out 6.1 between regular and C19RM, the total that you have there matches the total that you had as a closing balance as of December 2023. Of course, if there are any adjustments which need to be made, so these adjustments need then to be carried in section 6.5, because you're not allowed, or it is not a good practice as for you to report an opening balance which is different from the closing balance that you had as of the previous reporting period, which will inevitably cause triangulation differences in terms of when we do the final triangulation for the prompt. Now, again, open advance is broken down into 3 distinct components. So the first one, of course, is the SR open advance. And you will see that everything is grayed out here because all the information that is provided comes from the SR reconciliation tab. Then we have the procurement advantage that relates to PPM Wonbo only. So where you have grants that use PPM Wonbo, so the disbursement part will be pre-filled from the disbursements that have been made at the level of the Global Fund. And here it is important for you to identify what have been the value of goods and services delivered against those open advances. And then there's a third column, which is about all other advances, including advances where you have TB grants where the payments are made directly by the Global Fund to GDF, but it also includes other advances like local procurement advance, or if, for example, advances have been provided to PR staff to conduct their missions and so on. So this is what is captured in the third column. So moving on to the next slide about the key, the common mistakes that we have seen. Of course, when you speak of the opening balances, and this is also true for cash, So it is important that the opening balance that you have here matches the closing balance that you had for the previous reporting period. And again, one of the key arbitration elements that you will have to provide even to the Global Fund or the LFA when we are doing the review is the split between funding sources, again, because as of December 2023, this split was not there by C19RM and HTM. Now, the second part, I already mentioned that this open advance section is duplicated according to the different funding sources. And then what we have also provided is we have noted, based on the feedback that you have provided to us, also that there is a need to account for exchange gains or losses that arise on the translation of the ending balance at the level of SR. So if you have, for example, SRs where advances are provided in local currency, and at the end of the period, so when you are retranslating at the spot rate, the ending balance, so you might have exchange gains or losses. So this is now provided in what you will see as column 11 in the SR cash reconciliation tab. So moving on to the next slide, where you will see the SR reconciliation tab. I know that the figures are a bit, the font is a bit small for you to see that, but when we will share the information, you will see it better. So nothing has changed much in terms of the outline. So we always start by identifying, first of all, what has been what is the name of the SRs, what has been the cumulative value of expenditures that was validated. And it is important to note here that when you sum up the value of all the expenditures that have been validated in column 2, so this should match with what you have in your expenditure section. So the table C, which is about the implementers. So when you exclude the PR and you take all the SRs that are there, this is one level of check that you need also to be able to do in order to identify that the sum of all the individual SRs match what you have in the expenditure section. Now, the remaining sections are the same. So what has been the opening balance of SR advances, how much disbursements have been made to them, were there any other income that was accruing to the SR during that period? And then, of course, you will match what has been the expenditures which have been validated at the level of the PR in relation to these SRs. And as mentioned, we will have the refunds, but then also the net exchange gain or losses that arise on the translation of the ending balance. And the calculated amount that you will see in column 8 is actually what is the ending balance of the SRs that remain there. So moving on to the next slide, so about the common mistakes that you will see. Oftentimes we see that SRs are omitted from the list. So then when you compare the list of the total SRs that were implementing grants on behalf of the PR against what you have in the detailed budget and table C, so you find a mismatch there. Now, I also mentioned that the total expenditures for the period, so the total that you see in column C6 should match with what you have as expenditures incurred by SR as reported in the expenditure section C. So just a highlight here that when we are talking about the matching, we are also looking for the matching in total. So if you exclude in the implementer section whatever was implemented by the PR, so the sum of all the SRs should match the total that we have at the end of column C. Now, the same principle applies to disbursements. So in your PR cash reconciliation section, so there will be a total amount of disbursement that have been made to the SRs, and that should match with what we have in column 4, which is again total disbursements made to the SRs by the PR or even directly by the Global Fund. Now, item 4 is again the same principle. So what we have as the opening balance should match what we have in the previous financial reporting period as a total. And again, just like open advance, so this sheet is duplicated according to whether you had C19RM or regular funds together operating. Maybe moving on to the next slide, which is about commitments and obligations. So one of the changes that you will see there is that here it is grayed out, but the total amount of financial commitments at PR and SR level in this table, at least, which is the summary of commitments and obligations, will be a field that is editable and that can be provided by the PR. Now, one important element to note is that at the end of the financial closure period, so there shouldn't be any commitments that remain at least for the regular grant, because at the end of the cycle, there's no further commitments that need liquidation. So either the commitments have been liquidated or they have not. And we have already mentioned earlier that if the commitments remain unliquidated at the end of the period, so they will have to be transferred to the GC7 or the surviving grant. Now, the only exception here is that if you have continuing C19RM, so then you can still have financial commitments in relation to C19RM that remain at the end of the period. And this is where you will be able to provide the different information that is in relation to there. Again, financial obligations and that relate to PRs and SRs, anything that remains in the current financial reporting period would constitute elements that then need to move to the GC7 because they are actual contractual obligations that have not been finalized or liquidated in total in that current reporting period. Now, moving on to the next slide. So when we talk, as I mentioned, at FCR stage, so the commitments amount should be zero if your grant is ending. So meaning that if you have anything that remains, so these need now to be taken into the GC7, or if you have commitments which have been liquidated, but the amount that is has been liquidated is different from the amount that has been booked. So then appropriate adjustments need to be made to expenditures in the current period to reflect these different adjustments. And again, the commitments and obligations section is duplicated according to the different sources of funding. Moving on to the next slide, and I will pause a bit here because I've seen some questions and I will try to answer them as we go along. So the first part of the table, so module, intervention, activity description, cost input, implementer, type of implementer, and amount in IP currency actually come from the final PO. So what is important to note here is that this reflects the total amount of commitments that was expected to be liquidated during the closure period. So the column amount in IP currency reflects the amount that you had as commitment as reported in your final PU of 31st of December 2023. Now, what is the test for us in order to determine whether it is a proper commitment, which is why you had provided what was the delivery date. So if the delivery date was before 31st of December 2023, so it constituted a proper commitment. Now, what is additional during the FCR? So is the payment date, because the payment date will tell us whether this commitment that existed as of December 2023 was finally liquidated. Now, you will see an additional column, which is about the final payment amount. So again, reflecting on the example that I gave, so if you had, let's say, a commitment that was booked for $10,000 at the PU stage, but then during liquidation, it was finally liquidated for an amount of, let's say, 11,000. So in essence, this commitment has now disappeared, meaning that the commitment balance is zero. But then that additional amount that you have paid of 1,000 needs to be booked as additional expenditure for the period. Because again, remember that commitments already form part of the expenditure that you had reported as of December 2023. So substance over form, what needs to happen is that this additional amount of 1,000 needs to be booked into the expenditure for the period. Now you have a column which is about approved exception, but this column in relation to commitments should not be filled in right now. The only element where you need to fill that in is in relation to obligations. So as I mentioned, obligations, there could be what we discussed about AUP slippages. So let's say that you fill in that same form, but then the delivery date, let's say, is after 31st of December 2023. Let's take, for example, that the delivery date was 31st of March 2024. The payment date was 30th of May 2024. And the approved exception relates to the amount that was communicated by the Global Fund in terms of the slippage that was approved for this element. So this is where you will need to fill in that information. Now, let's take the example where you had, let's say, partial, you had a full delivery, but partial payments. So you had an obligation that was listed for 10,000 again. This was delivered on 31st of March 2024, but then you settled only 5,000 of that amount. So what would be appearing in terms of final payment amount is the 5,000. And then the remaining 5,000 that has not been liquidated would constitute amounts that we will need to take into the GC7, not as additional funding, but as elements that will need to be financed from the GC7 grant and from savings that will have then to be identified at the level of GC7. And moving on to the next slide. So in terms of the common mistakes that we see there, so very important element is the delivery date. So if the delivery date was before 31st of December 2023, it constitutes a commitment. If it was after 31st of December 2023, so then we would need to look at whether it was an item which was obligated, and then it will be the payment date that will determine whether or not it is still a commitment, that it is still an obligation rather that needs to be taken into GC7, or if it is something that is consumed within the GC6. And again, highlighting that AUP slippages are obligations that were approved by the Global Fund to be charged against the GC6 grant, subject to delivery and payment having been done before the expiry of the closure period. I mentioned about the exchange rate. So exchange rate, in case the commitment was liquidated for an amount different than the amount which has been booked. So it can go up or down. So you can have also situations where the final amount was settled for less than was booked. But in any case, remember that if the commitment has been extinguished, the ending balance is zero. And any adjustment to the amount that was initially booked as commitment needs to find its way into the expenditure section of the report. And again, as mentioned, this listing is replicated according to the different sources of funding. So I'll pass it on now to Bogi for the expenditure section of the FCR. Thank you.
Thank you very much. So for the expenditures, you will see that the expenditure report got a little facelift. In terms of content, it remains the same, but you will see the structure is also the same. The breakdown by the costing dimensions remain the same. You will have the 3 costing dimensions there as before. The only change here is that we simplified the entry points for the data. So the PRs now only need to enter the expenditure for the current financial reporting period, and everything else will be either sourced from the budget or sourced from previous periods and then calculated onwards for the cumulative expenditure for this reporting period as well. You will also see that the expenditure report itself, as most of the tabs are replicated for the different funding sources. So on the top corner, you'll see that's regular funds or other non-fungible sources, and the total separately. So you can have each view in a separate way. And another additional thing is that there is an add button for each costing dimension to add cost inputs or implementers or interventions and modules if those were not included in the original budget. And you will see that the variance analysis will be measured at the cumulative level, and this will be a mandatory field for variances plus minus 15%. Next slide, please. So some of the common mistakes for expenditures is, for example, adjustments from previous periods need to be made in the periodic expenditure column. Now you will only have this column, so there won't be many of those mistakes there, because the reason why we have those expenditure accumulation issues is that sometimes those corrections were made either in the periodic column or in the cumulative, and that caused an imbalance. And expenditures include non-compliant expenditures. So this is something we talked about. So these expenditures must be free from non-compliant expenditures and unrecovered taxes as well. And just to mention again, cash outflows, however, should not be adjusted for the same. And this is a new feature that expenditure section is duplicated for the different funding sources. It was already separated in the previous report for C19 and total, but now we separated them in a three-way, like every other tab. So it will be regular funds, C19 in this case, and the total separately. Next slide, please. So triangulation, as you know, it's the most important part of the FCR. And you will see that it's very small. Apologies for that, but it's a really big slide, so we couldn't put it in a more user-friendly way, but it looks better in an online form. So you will see that the cumulative triangulation is included now in the FCR and also in the PUDRs, and we'll be pulling out the data for each previous report. So you will see in this example, year 1, year 2, year 3 pulled out from each report separately. The structure of the PUDR remained the same as currently. So you will see the cash balance, the income, the expenditures, the net of financial commitments, and the advances, as well as the reconciling adjustments. And then you would arrive to the calculated closing balance, and then the cash balance is reported in 5.1, which would then determine the triangulation variance. So for the reporting period, also this is picking up the data from the various parts of the FCR, and then the cumulative column will be calculated automatically. So the only place where PRs need to make comments is just a comment box. There is nothing else they would enter here. Yes, next slide, please. And we talked about this before, the expenditure checks. So this was also in the previous triangulation, so we included here as well. So you will see that the expenditures will be picked up from each PUDR for the period, and then in 13.2.2, it will be accumulated to arrive to the calculated cumulative expenditures, and then the cumulative expenditure will be picked up from the FCR, the cumulative part, to check whether there is any variance. As I said before, here we shouldn't have any variance. If you see there is any variance arriving here, that means you need to go back and make an adjustment in the expenditure just to make sure that the accumulation is correct. Next slide, please. So some of the common mistakes in the triangulation, you will see that is automatically calculated. So it's mostly the justification that needs to be correctly linked to the various fields. And then there will be section 13.11, from 13.11 to 13.15, which are free entry sections for you to justify those variances. And then basically, you need to pay attention to those refunds that are previously not detailed in the previous PUDR form. So those are the ones where you could have justified variances carried over from previous periods. As just said, the expenditure checks in section 13.2 should be 0, otherwise you'll have a accumulation issue that will create a triangulation variance. We will look at it in the next slide, the section 13.3. This is a specific section just for GC6 and just for C19RM grants. It will populate also for non-C19RM grants, but you just ignore it. I will talk about it in a minute. And as almost every sheet, triangulation is also replicated for different funding sources from GC7 onwards, but for GC6, because we cannot separate certain elements of the triangulation by funding source from the previous reports, for GC6, there will be only one combined triangulation for the FCR. Next slide, please. Thank you. So this is the 13.35 section, where you'll see that we are going to reconcile the C19RM balances. So you'll have the opening cash balance of the C19RM. You will have this all pre-filled here. Then you'll see the disbursements for the C19RM, expenditures for C19RM 2020, and expenditures for C19RM 2021. And then the only field where you would need to make an adjustment is the C19RM, is the 13.3.5 for C19RM adjustment. So this will then calculate the C19RM balances, which will then eventually calculate the closing balance for the regular fund. So here we can go to the next slide. So I'll explain what you need to enter in 13.3.5. So why this was developed is because the previous PUDR form did not track the various funding sources, the reconciliation of the funding sources the same way as the current one. So there was not a dual tracking of the same. So what we would assume here is that there is an opening balance for C19RM that will be supplemented by the C19RM disbursements, and then we reduce the C19RM expenditure, and this is how you arrive to the closing balance of the C19RM fund. So all the other adjusting items of the cash reconciliation, like interest and etc., they will be borne by the HTM grant. Now, what happened is, as you know, we started the C19RM 2021 in June 2021, which for many grants, that was already 6 months past the start of the IP. So between this January and June 2021, there were some C19RM expenditures that incurred under C19 2020. Now, in some cases, there was some opening cash balance that was carried over from GC5, but there must have been some disbursements that were not recorded, that were not earmarked for C19RM before we started this disbursement tagging exercise. So basically, for those items where the expenditure of C19 2020 is higher than the rolled over cash balance for GC5, we would assume that there was a disbursement made, which was part of the HTM disbursement and which was not flagged separately, which is then, which we would need to sort of compensate for. So in this section, 13.3.5, you would need to enter basically a compensation for this disbursement. It's a bit complicated, but your finance specialist will be able to explain this further if needed, and we'll also have the clinics to explain this later on. Another adjustment that could be done in 13.3.5 is, for example, the Forex. We've seen back in the GC5 closure that some of the grants where the currency, the local currency, lost its value so much that there was so much Forex loss on translation that the PR wanted to allocate some of it to the C19RM funds. Otherwise, the HTM grant would have gone into a negative cash balance. So in that case, with the agreement of the country team, those adjustments can be made for significant Forex losses. Next slide, please. On tax reporting, so moving on to this. So as Fadil mentioned before, tax reporting is now in the FCR as well. Basically, it's because the FCR is we're still incurring expenditures there, so there might be taxes on those, so we need to report for those taxes. In terms of information, it remains the same. It's just the structure is different now and the look is a bit different, but in terms of structure is the same. PR and SR tracked separately. And what we introduced though is the section 12.5. It's very small, you will not see much, but it's basically total taxes reimbursed by the implementer to grant account, or the total taxes reimbursed by implementer to the global fund during the reporting period. So those are the new items which could be added here. And then you will see just for the FCR is what we call the final tax statement for the implementation period, where we would be pulling out all the data from each tax report during the IP to see it as in holistically how much taxes are left eventually unrecovered. Next slide, please. So some of the common mistakes is, first mistake is the tax exemption status is not selected properly for the PR or the SRs. And the second is the tax paid and recovered for the reporting period is incorrect. Taxes paid for all implementers and recovered either to the PR's account or to the global fund account must be entered correctly. You will see that here you are entering by the period. So we need to ensure that there is no duplication of taxes paid or recovered within different periods, because sometimes taxes are recovered not in the same year, but many months after. So just that those situations have happened before. So just ensure that there is no duplication. One important note, as I mentioned, there are two new items. Is the 12.5 is a reimbursement to the grant account, and 12.6 is a reimbursement to the global fund. Those were not part of the previous tax report, so those are new. So when you do the FCR, if any adjustment needs to be made, they need to be made in the current report for the FCR, so then the cumulative figures will be picked up in the final statement for the IP. Next slide, please. Non-compliant expenditures. So here we simplified it a lot. You remember previously in section 10, we had a lot more lines that were pre-populated. So for now, non-compliant expenditures, this will be also replicated by the different funding sources, but it's essentially one item for non-compliant expenditures during the reporting period. That's a one cell that the PRs need to enter here with a justification. What's important is that taxes should not be reported here. Taxes are supposed to be reported in the previous report that I just talked about, because otherwise it will duplicate the non-compliant expenditures, and we wouldn't want that. Next slide, please. So yes, exactly that. The common mistakes here is the duplication with the taxes. As I said, this report is also, like many others, is replicated for the various funding sources. Next slide, please. And I think I'm handing it back to Fadil.
Yes, thank you very much, Bogi. So we are nearing the end of the presentation, and we want to give sufficient time to answer your questions. So just very quickly on the PU. So what you can expect to see in the PU, so we've already covered most of it during this presentation. So the cover sheet, again, will remain the same. The cash reconciliation would be the same one that you've seen with the pulse check. The same thing for open advances, same element as you had in the pulse check. The expenditure report, as Bogi mentioned, the facelift that happened, and I saw a question in the chat. So basically, the expenditure. So if it is the first reporting, so if it is the first pulse check, so basically your current period expenditure will be equal to your cumulative expenditure. But extrapolating now, so once you have a PUDR which has been established, so let's say that we are talking about the PU of 30th of June 2025. So you will have a PR which had been established as of 31st of December 2024. And in that, there will be PR reported expenditure, so which is one of the sections which is provided in the expenditure report. And the way the cumulative expenditure will be calculated, it will be the sum of what you have reported in the expenditure for the current period against what you yourself reported as of 31st December 2024 in the PUDR. So which means that there's only one data point in relation to expenditure, which is the current period expenditure. And what this means also is that it leaves all adjustments, including adjustment to prior year reported figures, to be made in the current reporting period, which is as per the guidelines that we have always provided on expenditures. So just to say that this will simplify in some way how expenditures have been reported. So it will also help you in order not to make adjustments to cumulative expenditures, which will then have which may then have some impact when you do the accumulation, meaning that when you add year 1 plus year 2 plus year 3, you come up with a different figure than the cumulative expenditure that appears at the end of year 3. So that is to say how the adjustments have been made. Also, there was an earlier question on what to expect in terms of the variance analysis for an expenditure report, where we mentioned that this would have to be in relation to what is the progress that is being made to the target set out in the budget for the full year. What are the contextual elements that we have there in order to explain the direction of travel, whether we are, as PR, you are still on course to making it in terms of the objective that was set, any savings that could have been identified, any adjustment that will have to be made to how the activity is being implemented so as to reach that overall objective. And then non-compliant expenditures is exactly the same that Bogi mentioned just a couple of minutes earlier. With that, I think we've reached the end of this session. So in terms of next steps and resources, so moving on to the next slide. So when we will share that with you, just remember that we are also opening up weekly clinics to answer any questions that you may have. So you will see the time that is provided, so 1.5 hours every Tuesday between 30th of July and 27th of August. For you to come and ask questions specific that you may have. So we have sessions in English on Tuesdays, and we will have sessions in French every Wednesday between 31st of July and 28th of August. Now, next slide. So you will see also that we have prepared a number of links to resources, including presentations in French and English, the recording. We will also provide you with systems instructions on how to navigate into the partner portal. We will also provide you with some basic infographics that you can have handy as you go along filling in your PU and your FCR. And we will also provide you with the different demos, especially when it comes to how to navigate the partner portal. And as always, there will be the financial management resource page when you can see all the guidance, OPNs, and implementation guidelines that we will have there. That's it, I think. All right, moving on to questions and answers. So again, thank you very much for all these questions. For having run a number of clinics and info sessions before, I don't think we've ever reached that number of questions as before. So again, thank you for that. So we'll try to answer some of the questions that we had there, knowing that some may have been already responded as we went along through the presentation. So question 19 on bank charges, I think Bogi already provided for that. So bank charges will be taken against regular funds because the volume does not make it, let's say, ripe for it to be split between funding sources, and also knowing that PRs operate one single account. Question 20, pre-populated Excel will be provided. Can you reconfirm that we will be able to import the data? So I think this was also answered by Tanaka, but as I mentioned, in terms of the resourcing, there will be the different guidance that will be provided to you, inclusive of the demos. Question 21, disbursements to SRs, prepayment, refunds from suppliers, will it be netted off from the disbursements to other suppliers? So yes, we've already included that covered that in the presentation. Question 22, please clarify how this will be linked. So we mentioned that for the FCR, this will not be linked, but rather they will be editable fields where the PR can actually provide the required information. And this is because we have different scenarios. You have scenarios where regular funds and C19RM funds end at the same time. You have one where C19RM continues, and you have one where C19RM stop, but HTM continues. So which is why in the FCR, it will always be available as an editable field for you to provide the information. The amount in IP currency and final payment amount, I think I covered that in the commitments and obligations part of the presentation. Next slide. In terms of yes, so I also covered that in terms of the expenditure section. So basically, when you enter the information on expenditure for the current reporting period, so you will have two data points about cumulative expenditure. First, you will see the cumulative expenditure that you as PR you have reported in the previous PUDR, and then you will have the amount that was validated by the Global Fund. Now, why you have the amount validated by the Global Fund? Because you will also receive in your performance letters the adjustments that have been made by the Global Fund. So if any of the adjustments need to be reflected in your reporting, so you will need to take that prospectively in your current reporting period, meaning that you can adjust if need be. But all in all, what you're reporting in the current period will be added to what you yourself reported in the previous reporting period, so that when you take the cumulative, so it is your current against added to your cumulative that will constitute the cumulative expenditure at the end of the reporting period. 5.2 in cash reconciliation, so this Bogi covered. Question 26, the annual budget will be pre-populated. All right, so it will always be the annual budget that is going to be pre-populated. So if you have a 6 months PU for year one, so it will be your total budget for year one that will be pre-populated. And if you are, let's say, at month 18, when you are preparing the PU for year two, so it will be the cumulative budget for year one plus year two that will be provided in the PU. Bogi, can I pass it on to you for question 27 and 28, please?
Sure. Question on triangulation. Item 13.4, total expenditure per peer expenditure report will be Global Fund validated expenditure or as reported on the PUDR in year 1, year 3. So those will be the Global Fund validated expenditures that will be pre-populated there. And item 13.3.2, okay, so that is for the specific section for the cash balance split between C19RM and HTM. The expenditure C19 2020 and C19 2021. Please clarify these lines. Are you referring to C19 1.0, 2.0? Yes. So C19 RM 2020 is those two specific interventions and expenditure could have incurred until June 2021 under COVID control and containment and risk mitigation. And C19 RM 2021, those are the ones, that's 2.0, those are the expenditures that are now on a separate tab for reporting. 28, in the PUPDR, the tax report is to be populated based on tax paid and received for the reporting period, or should it be included? Should it include tax refunded in current period but paid in previous periods? Okay, so it's complex. Let me break this down. So this is for the reporting period. Okay, so everything that you report there is for the reporting period. And taxes refunded, during the period, okay? So even if those are taxes that were refunded from the previous period, so those were not refunded previously. So for example, if in year 1, you reported taxes of 100 and then you refunded them maybe in year 2, obviously those refunds belong to the current period. And hope this answered the question. Question 29, for the regular grant ended on 31st March 24, the closure phase is until September 24. Then in PU, regular grant expenditure for the period April-September will be included or not. So there is no PU, as it's explained there. As there's no separate PU, it will be only the FCR. It's a combined FCR thing that will basically replace the PU, as Fadil explained, because most of the, well, almost all of the PU is part of the FCR. The next question was covered in the presentation on 5.2, cash reconciliation. What does it include? This was basically all the advances that are brought back to the cash reconciliation to arrive to the final closing balance of the IP. Question 31, we need to submit a signed page. I will refer this to Tanaka. Maybe he can answer, I doubt it, but Tanaka, if you're online.
Yes, I remember this question was asked as well in the previous session, so I will suggest we will provide the written answer after the session with the rest of the questions.
Okay. Question 32, for C99 grants ending December 24, will there be a 6-month closing period? Yes, that's the short answer. The closure will always be 6 months for, except for those very specific cases where we can do 9 months just to avoid overlapping closure periods. Question 33, how to treat a financial commitment that cannot be paid off by the FCR reporting due date due to pending litigation with the supplier. The amount has to be paid once the litigation is finalized or settled. This will have to be taken to GC7. That also depends on, well, this will be a special case and you will need to discuss it with your CT, but generally speaking, this will probably be taken to GC7. And then the adjustment need to be made in the expenditures if it cannot be settled before the FCR is submitted. Question 34. Detailed expenditure section have a column for cumulative expenses reported by the PR and cumulative expenditure validated by the Global Fund. Which one is used in populating the costing dimension? This is covered in the presentation already. They're both there. Next slide. Ade, you want to continue for 35?
Yeah, so this question is a follow-up of question 29. So where the regular grant ended on the 31st of March 2024. And if you have also a C19RM that continues after that, so in the FCR, both reports will be contained there. So you will have to provide the same information on C19RM as if you were doing an FCR, and all the sections will be enabled for you to provide that information there. Question 36, construction contracts. So construction contracts follow the same principle as extended warranty. So meaning that only the portion that relates to the liabilities to be incurred into GC6 needs to be recognized and paid in GC6. And then any thing that remains to be paid after the FCR that will fall into GC7. So these will have to be taken into GC7. Question 37. Sometimes wrong opening balances are populated in the portal PUDR. Is it possible to make adjustment by the PR in the new format? So to answer that question, remember that if there are corrections to be made to opening cash balances, So you need, first of all, to make sure that the cash balance that you have matches what you had in the closing of the previous period. And then if there are any adjustments that needed to be made to that opening balance, so you need to take that into the adjustment and reconciliation section. So this is item 4.1, where you will need to provide the adjustments such that the closing balance that we have is the same as you intended if you were to adjust the opening balance that was there. Question 38, is it possible to talk through the template? So I think we just did that. We went through all the different sections of the template, but we will also provide you with a mock-up for you to use or to refer to. Question 39, in the PUDR, there are always adjustments made by the LFA. In the FCR, when the PR is filling their part, should code the LFA adjusted figures. No, I think here we already mentioned. So it depends on whether the adjustments relate to cash or to expenditure. So if it relates to cash, any adjustment that you need to make, it should be prospective. So you always start with the opening balance that you, as PRs, reported as of the previous reporting period, so the closing balance. And then the adjustment needs to come into item 4.1. Now, if you have adjustments that needed to be made to open advance, in the same principle, so you keep the opening balance that you had as per your previous reporting period, and then in section 6.5, value of goods and services delivered against, that's where you make the adjustment. Now, when it comes to expenditures, if you have adjustments that need to be made, so you don't adjust the cumulative figure, and this is in any way not possible anymore. So if you need to make any adjustment, you make that again prospectively in the expenditure for the current reporting period. Question 40, in terms of SR cash reconciliation and other advances. So I think we already covered that. Question 41. Okay, so we recorded the PPM expenditure. No, so basically what happens is that whenever a payment is made at the level of the global fund in relation to PPM or WAMBO expenditures, so this comes as a result of the process that is ongoing into WAMBO. So there will be demands that are made at the level of WAMBO from the PSAs and the suppliers. But these will always be accompanied by a notification letter that is sent to the PR in relation to the disbursement. Now, when it comes to the invoices, remember that the invoices, you will receive them when there is confirmation that goods have left the stores of the supplier through a bill of lading. But then once the goods are received in country, you as PRs need also to go into WAMBO and to confirm that the receipt of the goods has been made. And that's when you will also receive additional invoices in relation to freight and other ancillary services that come to this. But all in all, there will always be reports from the PSAs as to what have been the final amounts for the different orders. But you can also go and clarify into WAMBO or the PSA supplier statements as to the value of goods and that have been delivered against the different orders. Question 42. All right, so if commitments at December 23 was 1,000 and actual payment made was 950. So in that case, the total amount of the commitment is liquidated. So the ending balance that need to appear in 7.1 is 0. But then the expenditures need to be reduced by 50 because the actual amount that has been settled is different from the amount that was already included as commitments and therefore expenditure in the previous reporting period. Now, if the second part of the question, if there is a financial commitment for C19RM as of June 2024 of 1,500, Well, first of all, there is no slippage in relation to C19RM. So if I take this question as being C19RM that continues after the IP end date of December 2023, then that whole amount of 2,100, so which is the actual amount which has been paid, is what needs to go into expenditures. And that is the only adjustment that needs to be made, because remember, obligations are not part of expenditures, so they have not yet been recognized as expenditures. So irrespective of whether it was settled for 2,000 or 2,100, the whole of that obligation disappears because there has been delivery and there has been actual payment which has been made. Question 43, total cash balance also includes amount of cash in hand, which is categorized as an unreconciled amount. Do we only need to provide justification for this amount? So remember that when you're doing this cash reconciliation, so it is not only about balances that are held at the bank, but it is also balances that are held as cash on hand, but also balances that you may have with different service providers like mobile money operators and so on. So when we're talking about cash balance that appears in the cash reconciliation section, is the whole cash in relation to the grant. So it can be into multiple bank accounts, it can be into cash, bank account balance, petty cash as well, and amounts with mobile money operators. So which is why it is the whole universe of cash that we are considering here. And it is not it cannot be an unreconciled amount, because then you need to bring that back into your reconciliation purposes and identify that this is cash on hand. Question 44, will the FCR for the closing grants be pre-populated for the past year's expenditures? So you will have the cumulative expenditure as reported by the PR in the final PU, and you will also have the cumulative expenditure as validated by the Global Fund in the final PU. And when you report your expenditure for the FCR period, it is that expenditure which is added to the cumulative expenditure as reported by the PR to come to the cumulative expenditure for the IP at the end of the FCR. Question 45, there are refunds and Forex gains or losses, I guess, on PR open advances. What is the recommendation for use of these items? Well, to be clear is that when you have these refunds, so if these refunds are happening, so it will already be contained in your cash reconciliation section. So remember that there is a section on refunds there. Now, in terms of the use of these items, we are at the end of the IP, unfortunately, and whatever has not been used cannot be made available, but it will be considered as cash that is available for the next reporting period, or the next IP rather, where it will be put up against the amount that was signed for the GC7. Next set of questions. So question 46, I think there is a commitment approved by the city. Yes, so you can record this commitment, but only if it was settled. Again, as I mentioned, there cannot be commitment that survived at the end of the FCR unless it relates to continuing C19RM. So if it relates to HTM, which has closed, so then I see you coming on screen. So are we at time already, or can we just extend a bit?
Yes, we are reaching the end of the session. So I suggest maybe we finish this slide, and then we can close and wrap up and provide all participants with that information on how we're going to follow up regarding unaddressed questions.
Absolutely. So thank you for that. Basically, we will answer in writing all these different questions. We can even at some point post that in an FAQ that will be available. But all in all, it will be available as resources, as we have seen in slide, what is it? In slide 58, so this here. Everything will be available there. Maybe just to wrap up, it has been a very engaging session. I think everyone who is involved in this deployment are very much thankful for your active collaboration. Remember that there will be the clinics as well, where you can come with different sections. Pay attention to what we have provided in the slides. I know that this is a massive amount of information, but also remember that nothing much is changing in terms of the substance of what we have been doing in terms of the FCR. It is mostly the form that is changing, but it is changing for the good. And so we have taken on board all the comments that you have had, all the particular issues that you have had over time, and we have tried to incorporate this as much as possible. And we have also tried as far as possible to be consistent into the different reporting sequences that we have during the grant life cycle. So again, thank you very much for all your engagement throughout this session. Bogi, I'll leave you with the final word before we wrap up on this. Thanks.
Thank you very much for your questions, for your time. And we look forward to see you in clinics where you can come really and ask your questions. We will not have any slides in the clinics, so it's really for you. It's an opportunity for you to engage with us. Just one more thing to mention, obviously, your first point of contact is always your city, but we will be there to support you throughout this, closure period. Thank you, and have a good day for the rest of the day.